welcome back. I'm Heather Blonde from Elevate Global, and I'm here with my co-host, Seth.
Hello, I'm Seth, and today we're here to talk to Bill King with Four Kings Capital and to learn a little bit more about the lending industry.
So most people are only familiar with a traditional mortgage, but often they don't even understand that. So Bill, what are some other options you typically consider when looking at other types of financing for real estate investors? And are there any examples you could give of a situation that would be best suited for each?
Sure. Thank you guys for having me. As I mentioned, I'm in the finance business, so I'm a former banker, and now I do consulting for businesses and investors. And one of the things that you'll look at when someone's buying an investment property is first understanding how much time they have. A lot of times when they're buying these properties, they're under a time crunch to get a deal on the property. Another thing is you're looking at the current condition of the property. If it's what we call a value add, meaning you've got to do a lot of work to it to make it livable or make it sellable, that's something you take in consideration. And the third major thing that you have to consider is how large of a down payment are you able to put into the property? And those three things will kind of get us started down the road of deciding what's the best route for a buyer. So if you want an example, one example is, let's say you're buying a duplex, and this duplex has performed below market historically. And maybe it has some what we call deferred maintenance, which is a fancy way of saying that they haven't kept it maintained. So it needs a lot of work, a lot of repairs. A property like that may not qualify for what you call a conventional mortgage, which would be where somebody could buy it in their personal name. They would put 20% down and they get what's called a qualified mortgage. So the property probably wouldn't qualify for that because of the condition. So in a case like that, you would use what we call a bridge lender, also known as a hard money lender, which is designed as the name implies, a bridge. You're a bridge from where you are to a more bankable situation. So you would get a bridge loan that would allow you to do some renovations and construction to the property, get it to where it needs to be from a marketability perspective. And then if you're a buy and hold investor, you would look for permanent financing to then take it out, and you would hold it as a long-term rental. Or if you're a fix and flipper, then you're going to get it fixed up, you're going to get it listed with an agent, and you're going to sell it as quickly as you can to get your return on investment. And those are the two general variations that you see. You've got fix and flippers and buy and hold investors.
So I've got a quick question because I've dealt with both, and then we insure both. But I guess the question would be for the person that's going to do it to fix and flip. We get a hybrid of both where they'll do the fix up and then they'll hold some of them and then flip some of them. But is that hard money lender, that bridge lender, is that the best route to go for that type of person, or will they qualify for a standard mortgage?
That's a good question. That depends on multiple factors. That first, you look at the credit of the individual, you look at their experience in the industry. You look at how much liquidity they have, meaning how much cash they have to either invest in the property and invest in the repairs. And you look at all those elements. And there are available through regular traditional banks, what we call just regular renovation loans. So you could go to a community bank. I work with a lot of them, where I take my clients and they'll do a short term. It's like a banking version of a bridge loan, but it's not as expensive. So if they can qualify, for all the other elements where based off the property, based off of their credit, they have to have outside income usually, because one of the problems with that type of financing is a bank is looking at the source of repayment. So if you don't have outside income showing you could make the payments until that property is either rentable or until you can sell it, then you're going to have what we call a cash flow issue. Because a lot of times when people are buying these properties, they're already strapped personally. They've got a personal mortgage, they've got 2 car payments, their personal, what they call DTI, is already pretty high. So they can't support adding another mortgage on top of that if the bank was to look at it from an amortizing perspective and say, okay, if you had to make payments on this, could you make those payments? So that's a big determining factor. But to your point, when I help clients, the way that I work is I size up what general area they're going to fit in. Are they going to have a straightforward qualified mortgage where they can just take out a loan with 20% down and get a good long-term fixed rate? That's when the property condition is good. That's when their credit's good. They have good outside cash flow and they have time, because those type of mortgages don't happen overnight. So if you have to close quickly, a lot of times you'll go into a QM eventually, but you still may need a bridge lender. So to your other point is, when will you use a bridge lender versus going to a bank and getting a construction loan? A lot of it is time. Like, for example, I had a deal the other day, about a $2.5 million refi of a special use commercial property. Well, I've got them a commitment letter from a hard money bridge source in a week. In the commercial world, you're not going to do that for regular traditional bank financing. So the timing often can be a big determining factor, followed by those other elements of how much they have to put down in the property condition. And then, of course, experience and credit.
Okay. Do most people understand this coming in, or is this something that you really have to spend a lot of time and kind of educate them on?
No, that's one of the reasons I exist. Is there's one of the reasons I went out on my own is I saw that there's a big gap in the market, and I'm even talking on the business side where you're dealing with operating companies. You know, I'm working with a client right now that owns several little urgent care clinics, and they are brilliant at what they do, but they don't know finance. Everything that I talk about to them is something brand new to and they're good business people. I mean, they've got, $5-10 million business, but they're good practitioners at what they do. So there's nothing wrong with not knowing this stuff, because I know this, but there's a lot of things I don't know. So it's not unusual for someone to not be familiar with a lot of this terminology and a lot of this type of work. I specialize more in the commercial and small business side. I also deal with investors, but there's also some very good mortgage brokers out there on the residential side that can help a borrower get started initially. A lot of times I work with a lot of residential mortgage brokers. As a matter of fact, in preparation for our meeting today, I called one of them to get some information of how QM works and be sure that I'm not misleading the audience in some of my answers, being I don't do a lot of single family residential mortgages. But that's always a good place to start. If you can qualify for a regular residential mortgage and you can buy the property in your name, you can eventually transfer it into an LLC, and that's the way you would have to accomplish it to get what they call a QM, qualified mortgage. And that gets you a long-term fixed rate conventional. If you buy it in an entity to begin with, that becomes a commercial loan, which is my world. And when you're in the commercial world, that's different, because usually your fixed rate is not going to be as long, and typically your amortization is not going to be as long. So if you go with a conventional qualified mortgage, they're going to do a 30-year mortgage typically, and it's going to be fixed for that term. But if you have to do it as a commercial property, your amortization will more than likely be 20 to 25 years, and your fixed rate period will be more like 3 to 5 years commonly. There's some that are longer, but that's what you normally see in the commercial world.
How hard is it to switch if you take out a mortgage for a single family or for like a duplex or something under a QM, a qualifying mortgage, and then you start an LLC to put it into to protect yourself and your assets? How hard is that to switch over?
From what I've seen, the process is not very difficult. You would just get with the title company and tell them what you'd like to do. And in some cases, they're called a quit claim deed is one way to do it. The only thing that I can tell you on this, that I just have to be sure to say this, that your mortgage, when you get a mortgage in your personal name in any bank loan, is going to have what's called a due on sale clause in it, which means that technically if you change the ownership from your name to another entity or to someone else, the mortgage can theoretically come back and say, we're calling your note because you moved it out of your name. I've never seen anyone enforce that, but I just have to say that that is out there as a, just so they can say, someone wouldn't say, well, Bill said we could do this. I'm not saying you can do it. People do it all the time. And as long as you're performing on your mortgage, I've never seen anyone get in trouble with it. But when you do move it out of your name, it is technically a technical default in that you're not allowed to move it into a different entity.
Got it.
Wow.
So you had mentioned construction loans a few minutes ago. Is that something that if you're doing a fix and flip, you can take out a construction loan on, or what would that normally be used for?
Yeah, that's exactly what you would do. Usually your best bet for those type of deals are going to be local community banks, particularly in whatever market you're trying to do deals in. So, let's say you're doing something out here in Collin County. So I would recommend you talk to some of the local banks that deal with a lot of 1 to 4 family investor deals and talk to them about helping you do a construction loan. Give you a good example. Let's say you're buying a property for, I don't know, 200,000. Let's say it needs about 50,000 in work, and the ARV, the as repaired value, is 300, let's just say. So you've got a $300,000 ARV, and let's say that your lender is going to limit you to 70% ARV. So your total loan could be 210. And you're going to probably, one of the things that I've noticed people miss when they're trying to do investment properties, or they're trying even to do commercial properties, is a requirement that you now have to have a down payment. When you're dealing with your own primary residence, you can get in with as little as 3 to 5% down. In the investor world, that's just not the case. I know there's people out there that write books talking about you can do these no money down deals and all this good stuff. I've never seen many of those work out. My experience has been, if it sounds too good to be true, it usually is.
Absolutely.
But back to your point, I'm sorry, I got a little sidetracked. So you would take out a construction loan. So it'd be a multiple, they call it a multiple advanced draw note. So you would have the $210,000 would be the total availability. The initial draw will be to take down the property. I think I said it was going to be a $200,000 property.
Hmm.
So if you're buying it for 200, all of your money has to go in first. So you're going to put your, let's say 20% to the project for round numbers. You're going to put 40,000 down. The bank is going to fund the difference. Then the bank will help you fund the construction in multiple advances. That's why they call it multiple advanced draw note. But one of the things that's typical in any type of bank financing is they want your money in first. So you're going to usually put your money into the acquisition, and they'll help with the repairs.
So a lot of people have so credit, especially nowadays with the pandemic and everything going on. How does having poor credit or great credit affect lending for an investment property, and how does that differ from other business purposes?
First of all, it helps you, of course, if you have good credit. It's one element that's looked at. And when you look at the 5 C's of credit, it's a factor of character. How have you handled yourself with your finances? How have you dealt with your previous creditors? In the investment world, one of the good things is you have tangible collateral. So it's different than with regular business financing. If you're applying for a working capital loan or special equipment or things like that, that's harder for the bank to resell to somebody else. You're going to have a little bit more flexibility with having some credit issues. But what I would say is typically when you have credit issues, the credit is going to be more expensive. So you're going to pay a higher rate. And there's usually going to be a larger down payment requirement because the lender has got to make up for the fact that there's a chance you won't pay them back. Lenders are generally either cash flow lenders primarily or collateral lenders primarily. So when we talked earlier about hard money and bridge lenders, those are what I call collateral based lenders. They know that you've got an issue. You may have bad credit. The property doesn't cash flow historically. Your tax returns don't show you make enough money to buy the property. So they're going to have you put a larger down payment because now you have more skin in the game. And if they have to take the property back from you, they're going to be made whole that way. When you're dealing with traditional banks, they're more cash flow lenders first and collateral lenders second. So they're looking more at your historical ability to repay as well as your tendency to repay. And that's when you're talking about credit, is if you have issues, what I always recommend people do is pull your own credit report. You can go to any of the 3 bureaus once a year and they'll give you a free credit report, or you can go through all these services, freecreditreport.com, Credit Karma. Come to me, I'll charge you a fee and pull it for you. And look at what you have. And what I've learned in lending is that if you recognize the risk up front and then you explain it, you're going to do a lot better than trying to hide it. I mean, lenders are used to people trying to hide stuff from them every day. They're generally going to find out. So if they find out you've got a 620 FICO score when you're telling them you had a 700, or if you've got a bankruptcy from 3 years ago you just forgot about, they're going to know. So you need to be ready and you have to have your answers and your mitigating factors.
At what levels from a FICO score, because generally like 700 and above seems to be good credit. Are there any like tiers within that a person would want to understand before they go into the process?
Sure. That's a great question. In my experience, for regular bank financing, if you're north of 680, you're probably going to be okay. And another thing too that depends what's causing your score to be low. For example, my score has always been in the mid 700s, but I took advantage of some credit cards recently that gave me low rates if I used their funding for long term. Well, my ratio of credit availability to credit balances went up very high, and that dropped me 100 points for a few months. Fortunately, I
Wow.
wasn't looking for credit, so it didn't matter, but it irritated me. So your score can drop to 650 like mine did, but you still are paying on time with all your credit, but you just have a high, balance to availability ratio, or you have a lot of recent inquiries. So for me, it's as important why your credit's low or why you have the score you have as it is what the score is. But generally, when you get below 650 is where you start to get more questionable for regular bank financing. Now, in the hard money world, I've seen deals in the 500s, but again, they're going to be larger down payment deals. So they'll pull your credit, they'll look at it, they'll still ask you the questions, but that's not going to be a deciding factor that's going to stop them from doing the deal.
So you help match investors with lenders. What sort of value add do you bring to the table with your business
Yeah,
for
great
investors?
question. As I had mentioned, I was in banking 20 years before going out on my own. So I was managing lenders. I was lending money to businesses, typically deals from a few hundred thousand to 20, 30 million. And in a few of the banks I worked for, I was a voting member of loan committee, meaning I was a credit decision maker. And my last stop in banking, I was a market president of a bank before I decided I wanted to go out on my own. So all that means to an end user. So why do we want to hear all this stuff about Bill? I think about things from the perspective of the person making the final credit decision. So when you deal with a lot of other people that do what I do, they've got great background, great experience, but a lot of times their experience is as a producer. So they know how to submit a package, they know how to ask the credit exec for a loan, and they know how to fight for you and say yes or no. I think like the executive that's being asked. So a lot of times what I'll do is I'll pre-screen a deal and I'll ask you all the questions that I know we're going to be asked in a couple of weeks. So I joke that I save us 2 weeks because I'm asking the questions that are going to eventually be asked when we get the file in front of the decision maker. And that hurts me sometimes because I'm pretty tough on credits up front, where someone may be going to one of my competitors and they're telling me it's the best deal since sliced bread. And I'm saying, no, you've got a debt to income issue. You've got an issue here with your credit score. Your collateral is special use. I'll point out a lot of things that I know we need to mitigate up front. And that helps us down the road, but a lot of times up front it's a little rougher on the client.
So let's say me, just a normal Joe, wants to come to you and start the process. Because I understand certain things, but what would you tell that prospect that's wanting to get in? What ducks do you need to put in a row before they come and visit you to go through that process?
Sure. What I usually will do is I'll talk with the client about their personal finances first. I'll understand how their credit looks. I'll understand their income level. I'll understand their experience level. And one of the things that people overlook is even though you're applying for a business loan, what your personal balance sheet looks like still matters. So if you're upside down personally, where you've got a lot of credit card debt, you have high balances on your car loans, and you're showing that you're barely breaking even on your personal life, you're going to be hard pressed to get a business loan because when you're taking out money for a business or for a real estate investment, things come up. I have a good example. I've been a real estate investor for 15 years. And I took a call today from my property manager in Oklahoma that I've got $1,000 water heater bill I've got to take care of that I wasn't expecting this month. So if you don't have any cash reserves or available credit, you're putting yourself in a difficult situation to jump into becoming a real estate investor for the first time or starting a side business. So that's the first thing I look at is how is your house personally? And I look at how much research that you've done into whatever business you're trying to go into. If you're buying a business that you're going to own and operate. If you're buying investment real estate, I'm going to ask you, of course, about your experience, how much you're planning to put down, and ask kind of what your expectations are for pricing. My most common challenge that I see with first time real estate investors is they come into a deal wanting to buy, they're usually going to buy a value add property because those are the easiest to get into with less money. So you got a value add property, and then you have repairs that need to be made. The property doesn't cash flow historically because that's why it's a value add. That's why you're getting a good deal on it. But they want pricing like if they're doing a regular qualified 3.5% mortgage. And that just is not how it works in my world. So one of the things that I do with people is I size up what they know and what they think they know and how quickly and how closely it matches reality. And based off of that, I decide if there's anything we need to talk about or if I need to just refer them to someone else.
Being an investor yourself in real estate, what are some of the things you look for on a property?
That's a great question. There's a lot of great books out there of, how to pick properties, how to calculate your cash flow and everything. As a general rule, I look for an ugly property in a nice neighborhood. So if you've got a bunch of 2,500 square foot houses or 3,000 square foot houses that are all super nice, I look for the 1,800 square foot house there that's a second, third generation, and it's got a pickup truck from 1970 in the front yard and the neighbors hate them. I look for that property.
Yeah, that's smart. So if someone hasn't found the exact investment property yet that they want to buy, how soon is it, how early is too early to start discussing with you about their options?
What I recommend that anybody that's looking to invest in real estate, particularly we're talking probably more 1 to 4 family, for first time investors, I recommend you get your finances lined up first because especially in our market here in the Dallas area, there's no inventory out there. You've got too many investors making stupid decisions on properties that don't even pencil out, but people are buying them and bidding on them because there's not inventory. So I'm not buying right now. When there's too many stupid people paying too much for a property, I don't buy. I wish I was a seller right now, but I don't have any inventory to sell here in this area. But from an investor perspective, what I recommend that you do is exactly what I talked about. Get your personal financial statement ready. Get your 3 years of personal tax returns ready to send to a lender. You're going to hear some lenders say they only need 2 years. I'm telling you to have 3 ready. It doesn't hurt to have a third year, but have your personal tax returns ready for the last 3 years. For 2020, have your year-end W-2, have a couple of pay stubs ready, and get a personal financial statement form. There's plenty of them on the internet, or if you give them my info, I'll send them one. I would have all of that stuff on standby ready to go. If you have any available credit, you have equity in your house, one of the things that a lot of investors do is they'll get themselves a second lien home equity line of credit, and they'll use that as dry powder to invest into properties. So what you'll do is, let's say you can get a 50,000 home equity line that gives you some what I call dry powder. Then you can use that as your down payment on a property, and then you can get a mortgage from a commercial bank, or I can hook you up with somebody for the regular first lien on the property. You get it fixed up. If you're flipping it, you flip it out, you pay your line back down, and you do it all over again. So that's one strategy I've seen people do. Or if you're a buy and hold investor, what I've seen people do is they'll buy a property, they'll fix it up. They may do the same thing initially where they use a line of credit personally to get into the property. But once they get a property or two that they're holding, they keep the debt low on that, then they'll take a line of credit against that property, and that'll be their dry powder to buy other properties. Because what kills deals is time. So a lot of times when you get these you get these sellers that are motivated, they're frustrated, they're ready to just get rid of the property, but they need to do it quickly before they get their senses back. So when if you can set yourself up as an investor to have dry powder ready when it's time to strike, you're going to be that much better than your normal investor that's going out there applying for a loan.
Thank you so much for coming on our show today. I think, is there anything else you want to chat about?
No, we went over a lot of good stuff. If anybody needs any help and they want to reach out to me, I'm happy to have a free initial consultation to understand their situation. And fortunately, I'm not going to be a fit for everybody. And I know that. I've got a lot of great contacts in the mortgage business. I've got a lot of respect for a lot of the other intermediaries like myself, who put together deals. So usually if I can't help them, I can turn them on to someone who can.
Excellent. So this is Bill from Four Kings Capital, for the number four, Kings Capital. And it's fourkingscapital.com, correct?
Yes.
And if anyone has any questions, please feel free to comment below or send us an email. We're always happy to hear from you guys. And if you have any requests for future questions, please leave a comment. Thank you so much for joining us today. Have a great day.